Well, I begin from the slide number 13. So the concept of fiscally transparent used in paragraph 2 of Article 1 refers to situation where, under the domestic law of a contracting state, the income or part thereof of the entity or arrangement is not taxed at the level of the entity or the arrangement, but at the level of the persons who have an interest in that entity or arrangement. This will normally be the case where the amount of tax payable on a share of the income of an entity or arrangement is determined separately in relation to the personal characteristics of the person who is entitled to that share. So the tax will depend on whether that person is taxable or not, on the other income that the person has, on the personal allowances to which the person is entitled, and on the tax rate applicable to that person. Also, the character and source, as well as the timing of the realization of the income for tax purposes, will not be affected by the fact that it has been earned for the entity or the arrangement. The fact that the income is computed at the level of the entity or arrangement before the share is allocated to the person will not affect that result. In the case of an entity or arrangement which is treated as partly fiscally transparent under the domestic law of one of the contracting states, only part of the income of the entity or arrangement might be taxed at the level of the persons who have an interest in that entity or arrangement, whilst the rest would remain taxable at the level of the entity or arrangement. In the case of an entity or arrangement which is treated as a partly fiscally transparent under the domestic law of one of the contracting states, only part of the income of the entity or arrangement as might be taxed at the level of the persons who have an interest in that entity or arrangement, whilst the rest will remain taxable at the level of the entity or arrangement. For example, trust and limited liability partnership. For example, we could take into account a trust. A trust is an arrangement based on a fiduciary relationship in which one party, known as a trustor, gives another party, the trustee, the right to hold title to property or assets for the benefit of a third party, the beneficiary. Trusts are established to provide legal protection for the trustor's assets, to make sure those assets are distributed according to the wishes of the trustor. Well, in some countries, with respect to trust and limited liability partnerships, which are fiscally transparent entities, the part of the income derived through trust that is distributed to beneficiaries is taxed in the hands of these beneficiaries, whilst the part of that income that is accumulated is taxed in the hands of the trust or trustees. Similarly, In some countries, income derived through a limited partnership is taxed in the hands of the general partner as regards that partner's share of that income, but it is considered to be the income of the limited partnership as regards the limited partner's share of the income. So, to the extent that the entity or arrangement qualifies as a resident of a contracting state, the second paragraph of Article 1 will ensure that the benefits of the treaty also apply to the share of the income that is attributed to the entity or arrangement under the domestic law of that state. Most of tax treaties around the world are formulated in such a way that the definition of person in it doesn't recognize the existence of fiscally transparent entities. So they fall outside the ambit of the definition of a person. Therefore, these entities try to fit themselves in the words any other entity which is treated as taxable, as per the laws of its resident state, or as per the domestic laws of states for taking the benefits of the tax treaties. For the purposes of OECD Model Tax Convention, it doesn't matter where the entity or arrangement is established. The paragraph 2 applies to an entity established in a third state to the extent that, under the domestic tax law of one of the contracting states, the entity is treated as wholly or partly fiscally transparent, and income of that entity is attributed to a resident of that state. Convention ensures that the benefits of the convention are not granted where neither contracting state treats, under its domestic law, the income of an entity or arrangement as the income of one of its residents, and where they cannot verify whether a person is truly entitled to this benefit. Thus, if an entity is established in a jurisdiction from which a contracting state cannot obtain tax information, that state would need to be provided with all necessary information in order to be able to grant the benefits of the convention. A simple example. State A and State B have concluded a treaty identical to the Model Tax Convention. State A considers that an entity established in State B is a company and taxes that entity on interest that it receives from a debtor resident in State A. Under the domestic law of State B, however, the entity is treated as a partnership, and the two members in that entity who share equally all its income are each taxed on the half of the interest. One of the members is a resident of State B, and the other one is a resident of a country with which States A and B do not have a treaty. In such case, the paragraph provides that half of interest shall be considered for the purposes of Articles 1 to be income of a resident of state B. Now I speak about the Article 2, that is concern taxes covered by the Convention. This Convention shall apply to taxes on income and on capital imposed on behalf of a contracting state or of its political subdivision or local authorities, irrespective of the manner in which they are levied. The second subparagraph says that there shall be regarded as taxes on income and on capital all taxes imposed on total income, on total capital, or on elements of income or of capital, including taxes on gains from the alienation of movable or immovable property, taxes on the total amounts of wages or salaries paid by enterprises, as well as taxes on capital appreciation. The fourth subparagraph says that the Convention shall apply also to any identical or substantially similar taxes that are imposed after the date of signature of the Convention, in addition to or in place of the existing taxes. The competent authorities of the contracting states shall notify each other of any significant changes that have been made in their taxation laws. So, if we consider the convention between the government of the United States of America and the government of the Italian Republic, in Article 2, Paragraph 2, we can read: the existing taxes to which this convention shall apply are, in the case of the United States, the federal income taxes imposed by the Internal Revenue Code, but excluding Social Security taxes, and the federal excise taxes imposed on insurance premiums paid to foreign insurance and with respect to private foundation, hereinafter referred to as United States tax. In the case of Italy, the individual income tax, that is l'imposta sul reddito delle persone fisiche, the corporation income tax, that is l'imposta sul reddito delle persone giuridiche, and the regional tax on productive activity, l'imposta regionale sulle attività produttive, l'IRA, but only the portion of such tax that is considered to be an income tax pursuant to paragraph 2C of Article 23, relief from double taxation, even if they are collected by withholding taxes at the source, hereinafter referred to as Italian tax. Article 2 is intending to make the terminology and nomenclature relating to the taxes by the Convention more acceptable and precise, to ensure identification of the contracting state taxes covered by the Convention, to widen as much as possible the field of application of the Convention by including, as far as possible, and in harmony with the domestic laws of the contracting states, the taxes imposed by their political subdivision or local authorities, to avoid the necessity of concluding a new convention whenever the contracting state's domestic laws are modified. The paragraph 1 defines the scope of application of the convention, which are taxes on income and on capital. The paragraph 2 gives a definition of taxes on income and on capital, which comprise taxes on total income and on elements of income, on total capital and on elements of capital. Remember that social security charge or any other charge paid where there is a direct connection between the levy and the individual benefits to be received shall not be regarded as tax on the total amount of wages. With respect to taxes on income and on capital, the method of levying the taxes is immaterial. So it can be made by direct assessment or by deduction at the source in the form of sure taxes or sure charges or as additional taxes. With respect to income and capital, the definition includes taxes on profits and gains derived from the alienation of movable or immovable property, as well as taxes on capital appreciation. The definition also extends to taxes on the total amounts of wages or salaries paid by undertakings. I think it's enough for this part. I need a break.